Hello, everyone, and thank you for attending this latest FX Market Leader Series webcast. Settlement risk is on the rise, what to do, sponsored by CLS. In this webinar, we will be going over several key areas around why settlement risks have become such an important issue for the FX industry and the wider business. We'll be looking at what impact it will have, what steps regulators are requiring market participants to take, and finally, what models market players can adopt to further prevent these risks. My name is Joe Parsons. I am the Deputy Editor of the Global Markets Desk here at FX Markets and Risk.net. And I'm joined by a fantastic lineup of post-trade experts to discuss this increasingly important subject. So to introduce our webinar speakers, we have Lisa Danino-Lewis, Global Head of Sales for CLS Group, Sandra Laeli van Scherpenzeel, Executive Director and Global Head of Cash for Banks at UBS, Tom Owens, a Director at BNY Mellon, and finally, David Reed, Global Head of FX Prime Brokerage for Deutsche Bank. Thank you all for taking part in this discussion today. So addressing FX settlement concerns has emerged as a top priority for both regulators and the industry. So much so that following the Bank of International Settlements triennial survey in 2019, which indicated that a lower proportion of trades will go into payment versus payment systems, we have seen changes to the FX Global Code to address some of those concerns. BIS-CPMI also launched a consultation at the end of last year, calling for thoughts on existing, planned, or possible future solutions to expand the use of PVP for a wider range of transactions. So I'm sure we'll be going over some of these issues throughout this session. But Tom, I'd like to go to you first, really, to set the scene. Do you see the rise in settlement risk as an impediment for the FX business? And what are the primary areas where risk remains in the market?
Sure, thanks, Joe. I'm happy to be here. So I think in short, yes, I think this is a potential impediment. Impediment is a pretty negative word, but I think perhaps appropriate. As a settlement risk person thinking about this in the counterparty space, I view that as really a subset of the overall concept of counterparty credit risk, a very specific, very unique component of it. And I think generally what the industry has seen is a much heavier concentration on how we monitor counterparty risk, particularly when you think about events in the last 12 to 18 months of some pretty high profile defaults leading to substantial losses. I think was a pretty meaningful reminder that this risk is real. And I think following a period of rather benign conditions, we got reminded very, very quickly that these exposures can be very large. So I think to the extent the market can help refocus on that and continue to try and remove some of the settlement risk in the infrastructure, it'll be less of an obstacle for the growth of the industry than the effective operation of the industry. Where does the risk remain? I think there's really two subtopics kind of within that. One is the less controllable aspect of it, I'll say, and currencies that we all know aren't eligible for PVP. I think we've all, as people in the industry, been focused on particular jurisdictions lately where that's very relevant. But I think the more controllable aspect, and where we still see a ton of volume traded bilaterally, is about access and market participants still choosing to settle bilaterally and take that risk. And like I said, I think the period that we kind of experienced, I would say, between 2010 and up until maybe 2 years ago, was one where taking counterparty credit risk and settlement risk was very acceptable. And there's a lot of momentum, I think, behind that approach. And settlement methods and operational procedures tend to be pretty sticky, but I think you'll start to see that, albeit slowly, start to change as people begin to think about this a little more carefully and take lessons learned from the last, let's say, 18 months or so. So I think we'll come in and out of this topic as we go through, but I'll stop my view there and see if anybody else had a view to share.
So if I can, just from the CLS perspective, it's interesting that the BIS note that rise in PVP. We do continue to see growth in the service. Now, as Tom alludes to, it obviously is a subset of the currencies, and there is growth for risk outside of those currency pairs. In December last year, we actually had a record day through CLS, so we saw $15.4 trillion go through the service, and that is on the back of a funding requirement for our members of just 72 billion, so 0.5% that actually needed to be funding. So we're still seeing a pickup of those CLS currencies. Last year, again, a record high average daily volume going through the system of 6.19 trillion overall, which was up from the pre-pandemic high of 5.89 trillion. So, there is business coming through on those currencies. We are seeing, though, from a product perspective, some areas that remain outside, predominantly around the cross-currency swap area. And we have seen that interest pick up, certainly from our members in that side of the business. So there is more flow coming through there, but I think more to do. And as Tom alluded to, definitely, for those currencies that are outside, that still remains something that we are looking into to see if we can solve that for our members and our users.
And I think, Lisa, by the way, that the report is also showing that there is a case for the need of additional CLS third parties or CLS members, right, on those main currencies, but also on the growing, let's say, currencies outside of CLS. So I think the banking industry needs a bit of both. That is to say, more members joining the CLS communities on the major currencies to mitigate the settlement risk on those. And then a system on a PVP side for other currencies that can be complementary to it, because the system can only be as good as, the more members are there, the better for the benefits for the community itself.
No, that's right, Sandra. And I think, that's a really good point. In terms of the new growth we saw, actually over 90% of the new growth last year was from third parties, but we need members to support that business coming in. That's definitely an area of opportunity, I think.
Okay, excellent. I'm sure we'll go into that a lot more detail. But Dave, I'd like to go to you next as well, because I'd be really interested to know, what how important settlement risk is when dealing with your hedge fund clients, especially given some of the market events that we've seen over the past sort of year or so. It'd be great to get your perspective.
No, I mean, particularly in the hedge fund space, but really across the whole of the client universe, this is an area of critical importance. And I think particularly, as we've alluded to already, the structural changes that have occurred in the FX market and the enormous growth in emerging market currencies in particular has led to this expansion of what we might term non-CLS settlement. So we're constantly and across the industry, we're looking for ways that we can mitigate this risk. And I think that some of the projects that we're involved in with CLS around increasing the scope of the PVP infrastructure, and then looking at how we broaden that into the true, what you might term, client space, away from just the interbank market, these are, I think, really the next really big steps that as an industry we're going to have to take. But I think Sandra, your point around the growth of the third-party CLS market is really important. That there is perhaps a need for what you might term sort of flexibility of access. I think at the moment one of the challenges that we have is that these processes that we build are very they're very big institutional processes, and that's quite right that they should be that, because that leads to stability and security. The challenge is how we broaden that to give this greater sort of systemic security as well, without losing what is the core of the platform. So I think those are the sort of challenges that we face as an industry, whether that's in hedge funds, whether it's in real money, or even in the corporate space. How do we where real settlement risk exists, as well as obviously at the core of this in the interbank market across currencies that are that have been and continue to be challenging at the moment.
I'll just add one other consideration, Joe. I think as a risk professional, something we're always thinking about is not just how you measure and monitor, but what are the tools you have available to you if things were to deteriorate. And as Dave mentioned, the emerging markets growth that we've seen is one where the credit deterioration process, the default process, is a lot less transparent than it may be in other more developed areas. So I think it just further adds to the risk associated with that flow.
And I think, and we'll possibly come on to this earlier, but one of the other things that is really quite challenging in this is that, particularly in the emerging market space, although in a sense the end product has commonality, the reasons for the problems are different. So currency A has different reasons for fragility than currency B, and there isn't really what you have to be careful about coming up with a one-size-fits-all solution that isn't actually appropriate for all the individual markets that you're looking at. And that is really, I think, one of the bigger challenges in this. Never mind, obviously time zone, et cetera, but there are just really different underlying reasons why some currencies, never mind counterparties, have got risk characteristics that make them more fragile.
Yeah, I think we're constantly asked by our members and our clients, what's the next currency that's coming on board? And I think Dave sort of hits the nail on the head there. There's so many considerations when we look at the broader spectrum of currencies that remain outside. What model is optimal? Is that a multilateral? Is it bilateral? It won't necessarily fit within that one system fits all settlement as we currently stand. And we have to look at the account structure there, the legal framework, finality, which is a core of CLS settlement. How do we come up with a solution that has that flexibility in a way that Dave alludes to, that's necessary for those currencies? Because we have to treat them very individually, I think, just by their own nature.
And I think, Lisa, also the effort of CLS Bank to move also outside of the eligible CLS currencies and start developing additional solutions such as CLS Net, for example. CLS Net can be the fundamental, a fundament, right, for a PVP solution for those currencies that are not part of the CLS eligible framework. And I think really looking at the compatibility of such, different channels are very important. I mean, as Dave was also mentioning, in certain jurisdictions, the volatility of the currencies are presenting us with challenges almost on a quarterly basis. And if you look at those processes, they make the whole front to back process of chasing, forecasting the risk, and looking at how to mitigate more complex, while CLS would be supporting a certain automation and streamlining, right, STP of those processes, not to speak about liquidity and cost, which interest claims can also, raise out of those situations, just to bring it to a more operation practical level.
Fantastic. I'll be really interested to know about any sort of recent examples where settlement risk has really been highlighted, and maybe the experience that CLS has had in dealing with this. We mentioned about sort of emerging markets and those maybe volatile, that may be a lot more volatile than maybe the G10 one. And specifically, just an example, sort of the Turkish lira, which was extremely volatile at the end of last year and the beginning of this year. So is it? I don't know, maybe Tom, did you see any real sort of spikes in settlement risks or settlement failures at all during that time?
Yeah, I'll say I'll go back to early stages of the pandemic. I think as volatility in the market always spikes up, there's a higher correlation to failures. I don't have anything specific in terms of major losses that I want to highlight, but I think generally speaking, the attention and the focus and the amount of time that gets spent on the topic has certainly increased, particularly as I mentioned in Turkey previously. I would say the same conversations had going on in rubles. over the last week and month, perhaps. So I think the focus is certainly there. I think volatility leads to more concern, but open to any other specifics folks want to get into.
I think volatility per se is not necessarily, the problem. It's fragility is the problem. So when you have a particular market that is either that has a challenge, as I was saying before, around, say, time zone, or some of the things that are compounded around certain markets, like that are one-day settlement, these lead to greater problems of greater problems of settlement and higher levels of risk, and the higher levels then of potentially knock-on problems where a payment, a failure from one counterparty leads to, or a delay leads to a delay that knocks on into into other counterparties, and creates funding issues, and as Sandra said, alluded to, increased costs and problems that can kind of propagate across the across the market infrastructure quite quickly in some of the in some of these smaller markets. And again, this goes to what I was saying before around the problems being, what are the underlying causes of the problems in certain currencies, and how do we mitigate those in order that both clients within those countries and the broader global market can participate for the real needs that people have of doing transactions. This is not just around sort of speculative transactions, but around making real payments that are required for commercial need. It can lead to substantial problems in some of these markets. And I think these are the the things that we're trying to resolve underneath a broader umbrella of across the industry. How do we shrink this problem? That's, I think, Tom, you mentioned, we've been through a fairly benign period of time where, perhaps the focus has been more on, if you look on a fairly long time period, focus on G10. Now we've gone to an area where we're focusing, where there's a great deal of focus on emerging markets, a great deal of volume there, and perhaps an industry-wide infrastructure that's not necessarily fully attuned to that shift in balance of volumes, etc.
Okay, perfect. Really, really interesting. And Lisa, it'd be great to know, what how CLS what was their experience during these times of volatility, especially maybe in those EM currencies.
Yeah, well, I guess, Joe, for CLS, we touch on some of the I guess the bigger emerging market currencies, but we don't cover the likes of Turkey, we don't cover the likes of Russia, etc. But again, our members have raised these issues that both Tom and Dave and Sandra alluded to, and we are looking and working with the market to try and solve that problem. Is there an alternative PVP mechanism that we can provide for the market that helps alleviate some of these issues? But as Dave alluded to, it's got to be more tailored to the specific currencies than the existing system that we have that obviously covers 18, all under the same set of standards. Local market participation is critical in these markets. They are very dominant, and they're the requirement to have them as participants is important. And again, under the current CLS settlement, given our regulation and our framework, the membership rules are very strict, and the criteria is very, very robust. And I'm not saying any other system would be less so, but I think, again, we have to bring in that element of flexibility to make sure that we can cater for that local market. We need to have, the local central bank support and engagement in these currencies. There's a lot of work that needs to be done in order to facilitate this, but it's something, we've been looking at very seriously over the last year, 18 months, with the hopes that we can help the market in solving this problem.
Super. Okay, so I'd like to just lead us into the next part of this discussion. And so last year, the FX Global Code released its update, and it underlines the regulatory and market focus on mitigating settlement risk. I mean, it comes to sort of Principle 35. I mean, they changed it to say that market participants should reduce their settlement risk as much as practicable instead of taking prudent measures. And they do set out that firms settling FX transactions should use services that provide a PVP settlement where available. So, maybe following that release, Lisa, I'll come back to you. How have you seen the industry react to this, and how impactful has the code been to yourselves and to clients to really adhere to this guidance on settlement risk?
Yeah, thanks, Joe. I think it has been very, very impactful to the market. The updates, interestingly, beginning of this year, we started to see and have more dialogue with our members around what business they have that still remains outside of CLS that they could potentially bring in. And I mentioned earlier about, for example, the cross-currency swaps and that sort of principal final notional exchanges there, which they're looking to bring in. So we've seen renewed interest there. But interestingly, we've actually seen a number of our members come to us and want to discuss ways of us helping them to help their clients to come onto CLS and increase that PVP. And this sort of comes back and links into some of the points that we've already talked about, increasing that third-party participation in the system and how we get around that and how we improve that. So we are working very closely with a number of our members to help them directly, indirectly educate their clients on, what the service can bring, what those benefits are, how it helps them adhere to Principles 35 and 50 of the Global Code. And again, broaden that scope. I think, we've seen one of the biggest areas of growth and participation in the third-party space, or I guess there's two really, which is the smaller regional banks and the asset manager, the real money community, are very, very active participants in CLS. Again, some of the challenges we have are around, I think, the corporate market, and that's, again, goes back to the discussion we had about credit capacity at our members to support that. But certainly we're working with our members to help and to educate on that, to again, raise the awareness amongst that community. And I think, again, having a register for the Global Code, we've seen a lot of renewals of those adherences coming in on the revisions of recent dates as well.
Perfect, thank you. Sandra, maybe I'll come to you next as well. I mean,
sure.
How did you respond to maybe what the FX code, the update to that, and what it stated about settlement risk, and how have you kind of passed that on to your clients as well?
Yes, I think the regulatory pressure, especially in some jurisdiction, has driven clients to look very actively at CLS as a solution. And if I may compare to 10 years ago, you might have looked at banks mostly joining the client segment banks CLS only if their main domestic currency was part of the CLS set, right, of currencies. Mm-hmm. Today it's different. Today you would also see jurisdictions and markets that are more emerging, let's say, moving into a CLS membership as a third party, so through a settlement member, and at least eliminating, the settlement risk mitigation, having a benefit of that in those main currencies. And I think that is a big change that we've seen in the past 5 to 10 years in that regard. So the interest is really rising across regions, in some more than others, but you see also new markets coming into it. The FX Code of Conduct, with the 2 articles you just mentioned before, has raised more and more attention. So you see also a lot of treasury departments, raising it proactively as a topic. And if I look at the 4 main drivers for, let's say, a client segment like banks, for example, to join CLS, there are 4 main benefits they look at. It's the risk mitigation aspect we've mentioned now through the discussion, because there is also a lower capital requirement for the banks when you have such a centralized way of settling, those currencies. So the bilateral settlement actually is associated also with larger capital needs and costs related to that. The netting benefit, I mean, not to underestimate, liquidity has a cost today, cost of equity, market cost in terms of liquidity, cost in the market for certain currencies in particular. So having one simplified payment per currency to make either as a disbursement or funding has a huge benefit from a treasury perspective. And if you can, as a bank, quantify that benefit, you will see that there is quite a strong business case also to move into the CLS space. The FX business expansion, because obviously you become a part of the community who can trade potentially even more, right? Because there might be more credit appetite towards certain counterparts, and you might also find new counterparts within the community with whom you weren't trading before. So we also hear that it brings FX business expansion as well for the banks. And last but not least, the operational efficiency front to back, which should also not be underestimated. I mean, CLS offers a very simplified way also of settling the netted positions that are due in the market or from the market, and that has a huge benefit for banks as well. So when we look at the client base in the third party space, financial institutions, they might also have branches of the same group that they want to onboard as a fourth party. So there is also a fourth party layer to that. But we've seen also, funds being segregated and settled via CLS, asset managers looking at it, and selective CCPs apparently as well. So quite an interesting story, I would say, for different client segments and jurisdictions across the globe.
Definitely. Excellent. Thanks very much for that, Sandra. So yeah, as we mentioned, CLS is working with member banks to explore alternative PVP settlement models for currencies that are currently not eligible for CLS settlement. Dave, will an alternative PVP solution really help tackle the problem in your perspective?
Well, I think it will. What we're looking for here is ways really institutional. Look, as banks, we all settle all of these currencies with our clients and with each other all day, every day. That's what we're doing right now. And then the question is, how do we, is there a way that we can bring, across the industry and as an institutionalize these processes in a way that recognizes perhaps that they don't fit within the core CLS, the core CLS paradigm, but nonetheless can be part of a sort of a broader family of products that can reduce risk and enable perhaps all of the things that that Sandra just mentioned, those sort of four factors. Now, I think that these the work that's going on with CLS, the expansion of these the PVP model is really tremendously valuable, but it's a necessary response to the to the concern, if you like, that the regulators have expressed around the growth of this problem. And I think that the presence in the global code of the statements that you just mentioned are exactly exactly part of that broader response to a regulatory concern. So as an industry and as a primary provider in this space, I think it's incumbent on all of us and CLS as our primary provider to be able to come up with with products that help mitigate this broader risk that extends beyond the frontier that CLS has normally operated in. And the more that we create the more that a unified ecosystem can be created, then the greater the risk mitigation that we can achieve across that ecosystem. So the more utility-like it becomes, the fact that we can then start doing this in a much more efficient way with fewer payments starts bringing down the risk, and that's for the that works for us as banks, it works for the industry as a whole, and it works for our clients, which is really what we're trying to achieve here. And it gives obviously an output that the regulators are clearly very determined to see. So those are those are really the drivers for this, and the underlying product that we're looking at is something that we're obviously the industry is working very closely on with CLS at the moment.
And I think Dave raises a really good point there around that sort of that netting or that network effect that's super important for any solution. Realistically, what we want to move, or the market wants to move away from that bilateral risk and benefit from that multilateral netting efficiency if we can. So building any solution with that network is super important. That's something, again, that we've been discussing over the last 18 months or so, how best to do that and what needs to be in place to facilitate that.
You know, FX is a sort of inherently very fragmented industry globally, client-wise, etc. And anything that can be, you know, that starts to expand across all of those boundaries and bring things together to achieve these sort of, you know, centralization effects, I think are you know, is hugely important. And it does have, you know, other drivers. So better capital treatment, etc. These are things that are really important and becoming more and more important in FX. You know, whether it's with treasuries or it's, you know, costs within just straightforward costs of doing business. Never mind the pure risk element. You know, the pure risk element to this.
Excellent. And Tom, as well, you know, maybe just off the back of what Dave and Lisa mentioned there as well, what are your thoughts on you know, the importance of alternative PVP and kind of the importance of a network solution could have on the FX business?
Yeah, I think any industries, any businesses' ability to grow and accelerate is obviously linked to the infrastructure that's there to support it. As Dave mentioned, FX is very different from, you know, say the treasury market or even the agency MBS market, where that infrastructure has been in place as, you know, using a CCP model that's really allowed it to become extremely liquid, extremely efficient. So it's clearly different, but I think as Dave said, the ability for clients to access the market, you know, in a clean fashion hinges very much on the industry's ability to recognize the many benefits, not just on, you know, risk mitigation, but the funding and the treasury. So, you know, I think more PVP is always a good thing in isolation. You've got, you know, risk coming out of the system, but if you had, you know, multiple, I would say, sub-utilities operating independent from one another, the fuller benefits that we talked about, and Lisa talked about at the top of the call in terms of, you know, volume versus funding requirement, you don't capture the greater benefit. I know this is a settlement risk, you know, related topic, but the bigger picture of things that we'll take advantage of is something to keep in mind as well, because there's obviously huge advantages to that.
I was reading an article over the weekend, actually, which highlighted some interesting facts, and it was talking around the Mexican peso, which joined CLS quite some time ago now, but they were talking about the compound annual growth rate, and mentioned that in the first 5 years after joining CLS, the Mexican peso trading expanded over 22%. And again, a similar number around the Hungarian forint in the years 2016 to 2019. It grew something like around 18%, joined CLS in 2015. So I think that, you know, mitigating that risk, giving the market that security underneath and underpins these currencies and allows the market to have more confidence in trading. Obviously, we've also talked about, you know, that impact of introducing that assessment risk mitigation on credit and how that helps to extend it out as well in that space. But I thought that was an interesting way to look at it. Again, you know, if we look at the FX market, going back to the early days of CLS, you know, we've been in existence now for 20 years. The FX market was around 1.2 trillion average daily volume in the early 2000s. And now, well, we've got the new BIS coming out later this year, but in the 2019, 6.6 trillion. So, you know, again, grown considerably. And I think the more we can do, you know, not just CLS, but as a market to mitigate that risk, the more growth potential there is for the ecosystem.
Yeah, I think it's clear that every market participant will have a different appetite for settlement risk. So when you remove that variable from the equation, it's just a huge equalizer to allow, you know, a lot more access and a lot more relationships that may not have otherwise been possible.
Okay, super. And, you know, Lisa, you talked about how you know, this can be applied for across the board. It'd be great to know a little bit more about the cross-currency swap offering. I mean, what's the kind of are there any unique hurdles and challenges that the cross-currency swap markets face when it comes to PVP, and any kind of specific changes that need to be made to bring that under scope?
Yeah, sure, Joe. I think look, the cross-currency swap service that CLS offers at the moment is only open to members. So again, we were talking about broadening participation. We have, more of a limited scope there. But I think even within our members, there are some challenges, and I think predominantly that's because generically cross-currency swaps usually sits under the rate side of the business, and obviously CLS is very much driven by the FX side of the business. And as we all know, and the others can speak more to this as well, that normally rates and FX don't generally use the same back office, middle office support systems. So the challenge really for our members to put their flow into CLS is to link up their rate systems to their FX infrastructure and get that flow of information through to allow that trade then to move down and go through a CLS and go into the PVP. I mean, from a benefit standpoint, we find that actually normally the addition of cross-currency settlement, cross-currency swap flow actually increases the netting efficiency of our members. So there's definitely a lot of advantages just from that side of things, but also from a funding of obviously bilateral settlement of cross currencies. They're usually very large notionals, so that makes a difference as well. But I think the challenge that our members have is making sure their systems talk to each other. If they have that, then it's fairly straightforward to get that flow through. So it's not, from that perspective, it's sort of business as usual. It's just that internal link. And I don't know if Dave, whether you've got any more sort of insight into that. I know that is one of the challenges, I think, because of those operational sides.
Yeah, look, it's very much a problem across the industry. This is a problem of our own making, if you like. This is a problem that much as we hate to say it, silos exist within banks. They are very much, as you say, the rates world operates on different platforms very often to FX, but settlement risk is settlement risk. And ultimately the institution is facing the same sort of risk across this, irrespective of where the underlying flow, if you like, comes from. So I think it's really important that if we have a desire to remove settlement risk or reduce settlement risk rather, that we figure this problem out and we bring this into we look at settlement risk in a much more holistic way. And I think banks are doing that and figuring this out. But in many cases, it's really, it's definitely a non-trivial task to kind of come over these walls and ensure that at a sort of perhaps a treasury level or a funding level, that we're bringing all of these things into one place and achieving the appropriate efficiencies. It makes absolute sense to do so. But it's there equally clearly there are barriers to that, but barriers that need to be overcome. But it is it's very much something that I think that is being worked on. I know across many banks, and I think there'll be, I'm sure, you're probably closer to this than me, but many banks will be getting to this point, and I think probably sooner rather than later to achieve this goal.
Yeah, I think again that's that firming up of those principles 35 and 50 in the code, that regulatory sort of focus and lens on settlement risk has made, traditionally those that have just focused on FX look further afield, and definitely we've seen that pickup of conversations across our members on that cross-currency swap side. So I think that's going to continue into certainly this year and next, as we look to remove where we can, PVP from the market, or the settlement risk rather from the market.
And I think, as you say, some of these, the numbers involved, just the sheer numbers involved in the cross-currency swap space in particular are really, really meaningful. So these are big reductions there's a lot of, a lot of bang for the buck available, if you like, in that particular area.
Excellent. So I'd like to, we mentioned it earlier about direct and third party offerings to CLS settlement. But Sandra, I'd like to come to you next. How does adding direct and third party settlement services benefit your business and also your bank clients?
Well, I think it's the aspects that we also mentioned in the discussion, particularly the risk, the credit risk also aspect related to it, right? The optimization of usage of credit lines and expanding the business. So what Lisa just mentioned before with the example of Mexican peso is a development you see also with CLS third party, that once they join the community through a CLS third-party provider, they get access to a broader community of counterparties to trade with. So I would say that those two aspects are definitely primary in terms of for banks to move in. We see that in the main decision-making process, you usually have treasury counterparts, credit risk counterparts, but also head of operations. I mean, if they understand, as I mentioned, the front to back benefit that CLS brings to them and the benefit on the liquidity side, these are reasons that very often drive a decision-making process for a bank or another client segment to join CLS. Now, on the CLS third party, in terms of client segments, we've also seen pension funds looking at that. Obviously, when you look at volumes in the pension fund space, they usually have lower volumes but higher values. But obviously, if you are the house bank of such client segments, I mean, for them, the risk mitigating factor is extremely important. So CLS is an ideal solution for them. On the corporate space, as Lisa mentioned before as well, depending on the size of the corporate. And you may think that CLS is an alternative to prime brokerage, but it can actually be even complementary to prime brokerage and open up also, a broader trading sphere for the client segment. So I think there are different options that can be considered depending on what fits the profile of the client segment. And we see the development going in different directions, not only for banks in the third party space, but also, as I said, asset managers and also funds related business.
I like, Sandra, that you mentioned operations. Maybe we didn't give operations enough credit as we highlighted some of these topics before, but Dave said before, fewer payments is fewer fails, fewer knock-on effects, lower costs. Yeah, so it's there's something not to forget as we think about all the reasons this is helpful.
Absolutely. And another aspect, and Sandra, you touched on this earlier on, actually, when you were talking about some of the benefits, from an operational standpoint, having CLS for settlement allows you as a third party to effectively, in a way, outsource a lot of that settlement process and substantially reduce sort of the internal resource and focus that's needed to look at all of that post-trade work. So, there's obvious savings for CLS from a netting funding benefit, but I think from an operational perspective, yes, we've got, less settlement fails or none, hopefully, a lot less of a challenge around reconciliation, but we've also got resources that you can reallocate to other areas of the business because they're not needed to look at that traditional sort of post-trade workflow that you would have with bilateral. Many of our asset manager clients, love the fact that it's in CLS. They don't really have to think about it again. And there's a huge benefit from that, knowing that you've got that security, certainly from the asset manager space that traditionally always traded solely with their custodians, or where it was safe from a settlement perspective. It's obviously broadened that spectrum, allows them to ensure that they're looking at sort of best execution across the spectrum of aspects, as opposed to being sort of focused in sort of one area. Corporates, again, it helps. The thing with corporate treasuries is generally they tend to have less of a larger operational infrastructure. So the more you can do to in effect outsource that or reduce the risk and the focus that's needed the bigger benefit for you there. And I think, Sandra, you obviously you touched on the bank space very well as well.
And Lisa, I actually think that also the forecasting capability of CLS for a third party is extremely important also in cases of volatility or crisis, right? Through CLS, you can actually foresee or recognize some settlement patterns or delays very fast, which outside of the CLS context might be more of a challenge, right? Front to back in terms of operations. So I think, and we experienced it all in the past year, there have been, some currency crisis or situation in certain jurisdictions, and via CLS, there is quite a strong, robust framework that enables you to foresee and to act promptly on the situation. And I think from a risk perspective, this is extremely important as well.
Okay, perfect. I'll be interested to know really, what third-party access has been like for hedge funds and corporates. We've mentioned that maybe the requirements are quite tough for eligible currencies and also eligible participants. But Lisa, it'd be great to know, from your perspective, is there a way for a solution to be applied to everyone to really access a PVP solution, not just the big banks, but any kind of size of financial institution or corporate or hedge funds?
Yeah, I mean, Joe, CLS is obviously we transact directly with our members, and it's our members who offer those services on to third parties. So we have, as third party participants, we have corporates, we have a number of hedge funds. Predominantly those hedge funds are ones that don't transact via a prime broker, but have direct credit relationships. And again, asset managers, non-bank financials, banks, smaller regional banks. So we're open to everyone. We're not, we're not closed off there, but the restrictions really sit with our members and their appetite, I guess, from a credit perspective, primarily to support that business. Now, I think one of the challenges when we look at the corporate space is traditionally it would be the cash management bank who might offer CLS third-party services. And if that member doesn't actually offer third-party services, then it's hard for that corporate who has all their cash management with that bank to access CLS. It's not saying that there aren't others outside, other members who will support that, but it's a little bit more difficult when you don't have, I guess, the same oversight of that credit relationship, that depth of relationship than you would have elsewhere. So, that's not something that unfortunately CLS can control. We're very much, beholden to our members there to open that facility up with those market participants. But certainly, we have clients from every sector. We're talking to clients from every sector. There's definitely demand to do that. But I think the challenges really are around that provision, liquidity, and credit space. And I think, again, Sandra, you're the expert there. You can probably provide a little bit more color about some of those challenges.
No, absolutely, Liz. I think the aspect about where sits the cash with the mandate, obviously, of with whom you are doing CLS is an important aspect. But there are also ways to streamline that as well, right? In terms of on the corporate side, on the bank side, it's a different story, because obviously third-party banks usually have also their nostro providers in the different currencies, depending on the size of the currency in the different markets. But there are also ways, to consolidate certain types of currencies together in order to benefit from what you're saying, that the cash is sitting also close to that counterpart. But there are also automated solutions that can be offered whereby the cash management aspect can be very much simplified in that aspect. Absolutely.
Okay, excellent. And now, we're almost getting to the end of this discussion, and it'll be really good to talk about people's your thoughts on the benefits of multiple settlement providers in this space. We're seeing a lot of kind of the fintech side recognize the new technology solutions are out there for FX settlement and kind of solving for settlement risks. So maybe Tom, I'll go to you. What do you make of kind of this? These new solutions are out there, and do you think, or can BNY Mellon run a multi-settlement model?
Yeah, I think feasibility is, I think, less a concern. I think if with enough time, and large institutions are hard to move, but I think obviously capability is something that we can all think about developing if we haven't already. I think the one thing that, again, I think we touched on this, but comes to mind is the potential absence of some of the liquidity benefits. So I know treasury and risk professionals in the intraday liquidity space particularly, you'll think that adds a bit of a complication if you have different funding requirements at different utilities and perhaps at different times of the day. So I think that predictability, and the forecasting capabilities that institutions have, knowing when they're going to pay in and in what amounts, is still a challenge there, even with multiple providers. So I don't know if there are other thoughts on that, but when I think about multiple PVP things happening, that's good from a purely settlement risk standpoint. But I think to capture the flow benefits, we should be thinking about and working with the industry leaders on how to really tie those things together, to capture that fuller set of advantages we've been discussing.
Yeah, I echo that, Tom. I think, as CLS, we welcome any new method to reduce settlement risk, but I think you have to weigh up those benefits versus, as Dave mentioned earlier, that potential market fragmentation and the impact that might have on some of the benefits. Could it reduce the efficiency of the market and actually reintroduce elements of risk? So you have to sort of weigh up all of that, as well as the considerations we talked about earlier around technology is an important aspect, and it has to be robust, it has to be effective, efficient. You need to know that when there's a huge day, as I mentioned, we had a massive day in December, that it's robust enough to stand up to that capacity, but also you need that regulatory framework around it, the legal, to look at all of those different aspects of it. But I think, again, with that element of weighing up benefits versus the potential fragmentation that it might cause.
I think, Lisa, fragmentation per se kills the netting benefit, right? So, but fragmentation happens also with new fintechs coming in and bringing in new value proposition. I think you may not do a step of changing something for the sake and benefit of technology. You need to have a risk benefit related to it, right? So if we look now at CLS and the fact that the risk benefit is there for the community, the more Herstatt risk you take out of the system, the better, right? So I think that the numbers of members that are part of it is crucial for the success of this solution. Absolutely.
And just to put that into perspective of scale, CLS has been in operation now 20 years. We've got 70 plus members. It's taken us, 20 years to get to that stage. It's not something you can't build that network overnight. It's always a slow process. And, Sandra touched on the CLS Net product, which we launched several years ago. And again, that one's just building momentum and building scale, but these things take time. So that's, again, when we look at that impact, that benefit versus the potential fragmentation or the time it takes to build to scale, I think that's an important factor as well.
Okay, perfect. I mean, so you mentioned about the fragmentation risk there. Obviously, there is so much netting benefits and the network benefit of using CLS then. So with maybe these other kind of competitors and new kind of solutions, do you think it will be a case, or maybe Sandra, do you think it will be a case that maybe would see these kind of transactions maybe being a bit more local, or maybe given for individual markets as opposed to something that is cross currency, cross network?
I think they are happening selectively in selective jurisdictions. You cannot neglect them. I think it's on us really to monitor these new trends and to see which ones are getting a response from the banking industry with a new need or a new aspect, right, of mitigating risk. But as Lisa mentioned, the regulatory backup of these solutions is extremely important. So I think it needs also to have a regulatory support and backup, right? And to what extent some new rising solution may get that so fast, I think is questionable, but nevertheless quite exciting times to be monitoring and following, you know, what is coming up. But I think after all, the complementary aspect of things, as we were discussing earlier on in our discussion, right, the CLS eligible currencies, and then the new efforts of CLS Bank with members to look at the PVP in emerging markets, I think to find a way to have a complementary solution for these is really the key to a successful, you know, alternative for the market.
Yeah, I think that the innovation in general is a good thing, right? And it's important that we, that there's a broad variety of ideas, and the sort of stimulus, if you like, of competition is a good thing. And I think that equally there is easily the capability for platforms to be complementary to what CLS does. And for it to actually in the end broaden its reach. So I think look, I think overall it is a good thing. I think that as we've all said, the fragmentation parts of this, the more utility like, the more efficient funding is, etc. The more that there are very large advantages that brings, but there are, nonetheless, there are parts of our business that all banks that can be perhaps, there are new technologies that can be applied to that to make other internal efficiencies that flow further upstream. I also think that, and perhaps it's always somewhat compulsory you can't have a foreign exchange conversation without having bringing in digital assets and currencies, and there has got to be a joining up ultimately of these markets, and some of these fintech, the ability for these fintechs to straddle in what are at the moment these two worlds, I think will probably be advantageous in reducing settlement risk across that whole continuum. So I'm not sure that in the end it needs to be an either or, because there's a place. I think there's probably a place for both.
And that's probably the great thing that the innovations we've seen for both CLS and also the market is that this is a mutual problem to solve. That everyone's kind of realizing the need to tackle this problem, and it's really great to see stuff that's coming out. I'm afraid we're out of time now. Some really interesting thoughts raised by everyone on the panel. So I'd really like to thank Lisa, Sandra, Tom, and Dave for your thoughts. And thank you at home for listening as well. But with that, cheers.
Thanks, Joe.
Thank you.
Thank you very much.